Ready to dive into the financial markets? Today, we're uncovering expert insights that could shape your investment strategy.
Absolutely. We'll be featuring market analysis from top experts like Jason Shapiro and Jeff Snider.
Welcome to Financial Insights in Minutes, where we turn complicated analyses into actionable strategies.
Thanks to advanced AI, these expert analyses are condensed into just minutes.
Curious about how gold and silver are shining in today's market? Stay tuned.
Plus, we'll address critical concerns about the housing market and the potential for a significant stock market crash.
And remember, this content is for educational purposes and not investment advice. Today, Jason Shapiro dives into the current market chaos, focusing on the implications of recent strong economic numbers.
Exactly. Jason's insights highlight how these economic developments are affecting different asset classes.
Jason explains that gold and silver have remained robust in light of higher interest rates, which is noteworthy.
It indicates that these metals might act as a hedge against overall market volatility.
Jason notes that the market did not embrace the stronger economic figures, signaling a shift in sentiment.
Indeed. Typically, strong numbers would bolster stocks, but instead, the reaction was negative.
Shapiro emphasizes that gold and silver are shining brightly in a down market.
Interesting. He points out that silver's long positions are at historical lows.
Jason advocates for a focus on commodity currencies like the Canadian and Australian dollars.
This strategic shift could lead to better opportunities compared to the bond market.
Looking forward, Jason highlights that the release of non-farm payroll data could impact market reactions significantly.
It sounds like Friday's figures will be pivotal for market direction.
In conclusion, Jason's analysis suggests focusing on precious metals and currency strategies to navigate the volatile market.
Absolutely. His insights encourage investors to be flexible in response to changing economic data.
Today, we're unpacking the recent resignation of Canadian Prime Minister Justin Trudeau, framed by economic turmoil, as analyzed by Jeff Snider.
Jeff Snider argues that Trudeau's government ignored the economic realities faced by Canadians, labeling criticism as misinformation.
Snider articulates a vital thesis. Ignoring tangible economic troubles risks government stability.
Exactly. Snider highlights that central banks' decisions often fail to translate into real improvements.
Snider emphasizes that the backlash against Trudeau stems from rising unemployment and a perceived disconnect between the government and voters.
It's like living in a bubble. Politicians insist everything is fine despite real struggles. Snider critiques the reliance on central banks to solve economic woes, arguing that mere interest rate adjustments are insufficient.
So it's not just about more rate cuts, it's about implementing comprehensive solutions.
Snider points out that the Canadian dollar's depreciation reveals deeper economic issues that affect imports and inflation.
We've all felt that pinch. Prices are rising while incomes lag behind.
Snider warns that without genuine economic reform, Canada could experience more political upheaval.
And that sentiment applies globally, right? Just look at the UK and US.
In closing, Snider's analysis serves as a stark reminder. Ignoring economic realities leads to significant political repercussions.
Absolutely. The necessity for governments to genuinely listen to voters has never been more evident.
In today's analysis, Graham Stephan breaks down his insights on comparing investments in real estate and stocks.
He dives deep into his personal portfolio to see just how much he's made.
Graham emphasizes that the performance of real estate is highly contingent on when and where you make your purchase.
He found that stocks have generally outperformed real estate investments, particularly for purchases made after 2020.
Graham notes that his investments purchased before 2020 saw substantial increases in value.
However, post-2020 conditions led to mixed results for many investors. The reality is, while stocks often provide strong returns, real estate requires ongoing efforts to maintain profitability.
And with rising interest rates, many investors may find it harder to achieve expected returns from real estate.
Graham points out that rental properties come with various ongoing costs and risk.
Thus, for some, renting could potentially be a smarter move in today's market.
Graham predicts that without major market shifts, real estate values may not see substantial appreciation in the near future.
It sets a challenging tone for potential buyers, but provides insights valuable for investors. In conclusion, Graham highlights the need for extensive analysis and understanding of market conditions before investing.
His insights clarify that while real estate has its merits, stocks could be more profitable right now.
Today, we're summarizing Ken McElroy's insights into the current housing market, focusing on trends, challenges, and what's ahead.
Ken explains that the housing market is currently facing stagnation, with price freezes and reluctance from buyers and sellers.
Ken outlines 3 challenges shaping the market: rising unemployment rates, inflation, and low inventory.
As we see potential increases in unemployment, concerns grow about further impacts on the housing market.
Inflation is impacting household incomes and affecting home buying decisions.
Ken mentions that while unemployment appears low, underemployment hampers purchasing ability and affects housing demand.
This dual issue of underemployment leads to less confidence in making significant purchases.
Ken discusses the lock-in effect. Homeowners with low-rate mortgages are less inclined to sell for higher-rate homes.
It raises the question, why lose a 3% mortgage for a higher rate nearing 7%?
This sell-off, likely initiated by profit-seeking investors, could increase supply and create opportunities.
If Airbnb properties aren't profitable, this could lead to more availability on the housing market.
Ken predicts, while the market remains stagnant now, increased construction may stabilize prices by 2025.
He warns that rising homeownership costs will persist as a key issue.
Ken's insights underscore critical factors affecting today's housing market: economic challenges, the lock-in effect, and rising costs.
For homebuyers and investors, adaptability and preparedness will be vital for success.
Today, we're breaking down a tumultuous moment: the resignation of Federal Reserve's top financial regulator, Michael Barr, and what it means for the future of banking in America.
Barr's departure raises many questions. Can President Trump fire someone from the Federal Reserve, and why did Barr step down now?
Mitch, what does this resignation indicate about Trump's influence over the Federal Reserve?
It suggests Barr felt threatened, choosing to resign to sidestep potential confrontations rather than face scrutiny.
It seems like Trump can't just fire these officials. How does this reflect on the Fed's supposed independence?
True. While they assert independence, political pressure often complicates their actual autonomy.
You mentioned that Barr's regulatory proposals were controversial. Why do you think that is?
Banks are resistant to oversight as it affects profits. They prefer high leverage for better returns.
How does consumer spending fit into this economic scenario?
Increased demand brings inflation, especially in a recovering economy with supply limitations.
Looking ahead, what do you envision for the Fed under a Trump administration?
If Trump pursues deregulation, inflation could worsen. It's a complex situation with risks for consumers.
Public engagement seems vital in driving these changes. What actions can consumers take?
By educating themselves and voicing concerns to leaders, consumers can influence significant policy shifts, especially during inflation crises.
In a recent discussion, George Gammon highlights a significant warning from Fed Governor Lisa Cook regarding potential risks in the stock market.
Cook's comments resonate with historical references to Alan Greenspan's 1996 irrational exuberance speech, indicating current market valuations may be similarly precarious.
Cook points out that many asset classes, especially corporate debt, are experiencing alarmingly elevated valuations.
This priced for perfection scenario means any negative news could provoke significant declines, an essential reality for investors to consider.
Gammon emphasizes that Cook's warning concerning high valuations indicates heightened risks in today's markets.
Indeed, the current state shows a risk-on mentality that could lead to negative outcomes for investors when market sentiment shifts.
They analyze the cyclically adjusted price-to-earnings ratio, which is remarkably high, reminiscent of past market downturns.
While it's crucial to recognize risks, predicting exact timing of market crashes is improbable.
Interestingly, Gammon asserts that declining bank reserves aren't the only crucial factors influencing market dynamics.
Correct. Ultimately, market sentiment, driven by perceptions of liquidity risks, plays a pivotal role.
Looking to 2025, the overview provided carries serious warnings. Substantial declines may be forthcoming.
Gammon stresses the importance of understanding these indicators to prepare and adapt investment strategies accordingly.
Ultimately, Gammon's analysis acts as a critical alert for investors, maintaining caution is essential in volatile times.
Every astute investor should ideally be asking, what risks exist and what safeguards are in place for my portfolio?
What an insightful discussion we've wrapped up today.
Indeed, Lisa Cook's warning about asset valuations was particularly eye-opening.
Absolutely. And Mitch Wexler certainly stirred the pot regarding political influences and Fed independence.
Right? It's crucial that we stay aware of how such dynamics could sway our financial future.
And Ken McElroy's take on the housing market, blending challenges with potential resilience, is a fascinating contrast.
Totally. And then there's Graham Stephan, who balances real estate opportunities against stock market trends.
Not to mention Jeff Snider's point on Canadian economic realities. It's a stark reminder of the nuances involved.
And Jason Shapiro calling for a pivot to commodities was refreshing and certainly thought-provoking.
If you enjoyed these diverse perspectives, make sure to give us a thumbs up.
Yes, your support is vital for us to continue delivering more expert insights. Don't forget to subscribe.
Stay tuned for our next episode, where we'll delve deeper into investment strategies tailored to volatile markets.
You won't want to miss that. See you next time.